It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. The yuan jumps after the PBOC signaled support for the currency, while the risk of intervention from Japan stalls the yen's decline for now. Equities in wait-and-watch mode as investors look ahead to a busy week of economic data, including the Fed's preferred inflation gauge. Also ahead, Pakistan's new finance minister says he's keen to tap Chinese investors by selling as much as $300 million in panda bonds this year for the first time. And we have some great interviews lined up. Manulife Investment Management's Mark Franklin with his market outlook. Plus, we'll look at the Asian private equity space with MCM partners Janavi Bhagwati. First, we're off to markets. Let's get to Avril Hong for the very latest. And Avril, you get a sense there's trepidation, there's nerves ahead of the PCE data.
Yeah, I mean, it almost looks like a pullback from the performance last week where we got those dovish signals from global central banks, and that seemed to help stocks and bonds to rally. But today we're seeing the rally in treasuries stalling a little. The Japanese benchmark, the Asia stock gauge, they are slipping. Some of the market enthusiasm being taken out. And today we also hear from the top currency official in Japan that verbal jawboning, intervention, most robust comments on the FX moves in a couple of months. But by far, the attention for traders is squarely on the offshore-onshore as they weakened last week on Friday to those 4-month lows. Today, the PBOC's yuan fix sending the signal because it's the strongest versus estimates in the past couple of months. It seems like what we saw on Friday was something the PBOC was not that comfortable with. So we're not just looking at stocks, but also the FX space today, Has.
Well, that's right. The yuan carry trade is one that's being focused on by traders. What are you looking at?
Yeah, I think it's been increasingly an attractive form for the funding, and we're seeing how the offshore yuan forward points today are turning even more negative, really making the case for the EM carry trade. And it's also worth remembering why. It's because of its low volatility, relative, I guess, but also how it is seeing limited scope for appreciation on the Chinese currency, especially given the economic conditions in China, and not forgetting, if you compare it to, say, the Taiwan dollar or the Japanese yen, put it in perspective, given how last week we had the BOJ exiting negative rates and then a surprise hike from Taiwan. So the yuan as a funding currency still looks very attractive.
That's right. Big moves in the currency market. Let's dig deeper into those big swings in FX markets with Bloomberg Intelligence Chief Asia FX as well as rate strategist Stephen Chu. Stephen, let's have your take on the yuan supported by the fix today. But you know what? PBOC is saying it is not quite ready to be tolerant of a weaker currency.
Yeah, that's right. I think we have to remember that yuan tends to be quite strong in the first quarter because of seasonal reasons, because of Chinese holidays, because of market looking forward to some positive measures out of the two sessions. And that's why, actually, if you look at the regional performance, the CNH and CNY has been quite resilient until last week. So now, first quarter, it's nearly done. So internally speaking, the yuan seasonal tailwind is gone. So now market will focus back on the structural issues for China. For example, the basic balance is still slowing, and then we are still seeing rate differential in favor of the dollar. So basically, that's why the yuan start to drop again. And of course, market want to get support from the Fed. They want to get even from the BOJ by having a stronger yen. Hopefully, we also drag the yuan higher. But of course, last week we saw that the Fed is not quite ready to cut, at least not before June. And the BOJ, yes, they did hike for the first time since 2007. But as you can tell from the market reaction, from the yen, from all that, market is disappointed. It's not strong enough. So that's why the yen slumped and the yuan couldn't get help from there as well. So that's why right now the yuan is facing renewed pressure against the dollar.
Stephen, when it comes to the yuan, was the PBOC testing the markets to see the reaction from investors if that fix was weaker than anticipated?
I mean, you can see like once the PBOC last week, for example, they set the fix just slightly higher than 7.1, then you saw the spot basically just sort of collapse. So that's why today you saw they fix it back below 7.1 to stabilize it. And of course, we saw the CNH back at 7.25 and sort of stabilize a little bit. But the thing is, like over the next few weeks, if the dollar stay resilient, then it's very hard for them to keep doing this. Then probably they will have to be more forceful in terms of supporting the yuan.
And when it comes to the yen in particular, Stephen, we saw jawboning from Canada today. I mean, it is an effort to prop up the currency. What would it take for actual intervention? The last time we saw that, it was when the currency touched 152.
I think it's very close because usually we look at two metrics. The first one, as you said, is the level. So now we are close to 152, so we are there. The second metric is the pace of the yen drop, where if you look at the yen over the last 2 weeks, I think we are talking about near 2% drop over the dollar per week. So I think that's fast enough. If you look at the two interventions back in 2022, that's the pace that will trigger the BOJ. So that's why we saw Canada this morning talking about they are watching the market. And usually what preludes the actual intervention is they will come out and say they are checking the FX rates. So when we saw that statement, then we have to be really careful of actual intervention in the yen.
All right, we'll keep a watch on that. BI Chief Asia FX and Rate Strategist Stephen Chu, thank you for your insights. Now, to continue the discussion on what's next for major currencies, let's bring in Mark Franklin, Senior Portfolio Manager for Asia Asset Allocation at Manulife Investment Management. Mark, good to have you with us.
Good morning, Haslinda.
For a very long time, Asian currencies have been driven by the USD. Yet when we saw the sinking of the yuan on Friday, we saw ripple effects in the Asian currencies as well. I mean, how are you reading all the movements?
Well, we think that the yuan has effectively been managed very carefully for some time by the PBOC. And ultimately, they sent a message to both Japan and the US on Friday to signal that they're getting uncomfortable with the pace of the weakening of the yen and the loss of competitiveness for Chinese exports. If you start to see the yuan weaken precipitously, that would effectively signal to the global economy, particularly the regional economy, the exporting of deflation. And that's why you started to see a ripple effect in Asian currencies on Friday. But fast forward to today, things have calmed down. And don't rule out the possibility that there's a high degree of connectivity and communication between US Treasury, the Japanese Finance Ministry, and also the PBOC.
We know that it's been a story of USD exceptionalism. Some say it is overvalued by 3 to 4%. By the same token, the yuan should be weaker than it is right now. What is the right reflection of the economy in China?
I think China's strategic goals right now are to create a certain degree of resilience, particularly in commodities where it's importing and the pressure is to import. We've seen inventory build not just in gold as an alternative to US Treasury holdings, but also significant build of inventory in foodstuffs, commodities and so on. In that context, the PBOC and the Chinese Finance Ministry want to maintain a relatively stable, resilient currency in order to make sure that the importing of those commodities doesn't become too expensive.
So where is the yuan headed by year-end?
It really depends on the extent to which they're satisfied with the level of inventories and effectively the firewalling of the economy from outside influences and pressures. It will ultimately be driven by rate differentials, and therefore we also have to look to the US, the extent to which interest rate cuts priced in by the market continue to get priced out. For the time being, it looks like the Fed has pivoted towards a priority of growth, and therefore rate cuts will probably resume by the middle of this year, and therefore those rate differentials should narrow. So don't rule out the possibility that that creates a certain underpinning to the yuan, and actually weakening pressure is relatively modest.
And for Japan and the yen, we heard Canada saying today that it is not a reflection of its fundamentals. Do you agree?
It's a reflection of rate differentials. So yes, of course, the Bank of Japan moved rates, but by only 10 basis points last week. Rate differentials are still in excess of 500 basis points. Ultimately, the carry trade is still very much attractive to global investors and asset allocators. And so whilst that is in place, there will be weakening pressure on the yen. The thing that could reverse that is rate differentials narrowing in the favour of Japan, and that would be driven in part by the Fed accelerating its rate cuts, which is not our base case at the moment, but also an acceleration of the Japanese economy. Don't forget, late last year, the Japanese economy was flirting with recession. So even though wage inflation is starting to move in their right direction, the growth picture is still very, very modest because Japanese domestic consumers are still seeing pretty low sentiment and are not particularly optimistic about the outlook.
So you're saying that the right move for Japan right now is to stand pat, just wait for the Fed to make its first move?
It's a very, very favourable backdrop for the Japanese economy. The yen is weakening fairly modestly but consistently. That creates greater competitiveness for Japanese exporters. The one pressure point is really on domestic consumers, and at the same time, political approval of the current government is very, very low, and that's also a reflection of the concern that wages have not kept up pace with inflation. So they'll watch very carefully the extent to which the government continues to lose approval or whether that reverses. If it starts to reverse, then they'll probably be quite comfortable allowing this move to continue.
Mark, let's get to the bond market. Bond traders now factoring yet again that the Fed will move soon as June, and they've been burnt by this trade before. How best to position in the bond market?
We have to look very carefully what's going on under the hood. We've seen a very, very significant increase in one-year break-evens in the US from 2% at the start of this year to over 4% now. That is the market effectively saying that they believe that the Fed is now going to try and allow the economy to run hot into the election. So you have a twin, very, very loose policy setting on the fiscal side and on the monetary side, and therefore we have to be a little bit careful about taking duration risk right now. But at the same time, it seems to be the case that there's an appetite for buying duration again, and there's still a perception out there that the economy will slow down in the US over the coming quarters. If anything, there's a chance that, for example, driven by housing, the US economy and inflation could re-accelerate in the second half of this year. So what we're effectively doing is we're getting cautious when the number of rate cuts that get priced in is too high, and we start to be more constructive when the number of rate cuts that get priced in by the market looks low. And we're heading towards that low point now, but the risk actually is that 2025 rate cuts, something like 60 to 70 base points, get priced out, because even if the Fed starts to move in the middle of this year, if inflation is re-accelerating, once you get through the election, then the next administration will definitely have some challenging economic questions to answer at that point in time.
So where do you seek protection? Because assumptions could be wrong. Already for 2025, we're expecting fewer cuts than that were priced in perhaps last year.
If you look at what break-evens are doing, it's telling you to be positioned in those asset classes that are resilient in the face of rising inflation. So we like floating rate notes. We like Treasury-linked inflation bonds, particularly at the front end. And we also like commodity exposures as well. So that's giving us a bit of resilience to rising inflation, but still active in fixed income markets.
I hear bonds, I hear commodities, I don't hear stocks. How much more upside are we expecting from the stock market?
We think there's quite an interesting rotation play that could happen in US equity markets. We saw a flavour of that over the last few weeks. Some of the more cyclical sectors, whether it's energy, industrials, they're starting to catch a bid, and we think for good reason as well. There's been very pronounced leadership by the technology sector, and that's been driven by fundamentals. Earnings revisions have been strong, share buybacks have started to pick up again, but we like the idea of rotation under the hood, even if that doesn't mean that at the index level you see very, very large gains from here on in. So our focus now is looking for parts of the market that have lagged somewhat, but have some fundamental support that is improving.
What are you staying away from? If you take a look at the markets right now, there's a lot of herd mentality. I mean, everybody's putting into assets, the same assets, for a very long time.
I think what we want to do is be wary of mispricings in the market. So
and where are you seeing that?
Yeah, I mean, I think that the question becomes the tail end of, let's say, growth stocks in the US, which have been brought up by this rising tide, whether it's the AI theme or whether it's other types of themes as well. So we think that you have to be careful at the single security level, avoiding stocks which have appreciated in valuation but lack the growth story, or that growth cycle is starting to slow down. That's where you have to be a little bit careful. We need to get a bit more selective.
All right, Mark, hang tight. Mark Franklin, Manulife Investment Management, is sticking around. Now here's a quick look at the week ahead. Japan releasing a slew of economic data as investors try to figure out the BOJ's next move after the central bank raised rates for the first time in 17 years. Bloomberg Economics thinks Tokyo's core CPI probably eased this month, but could still stay above the BOJ's 2% target. China, meantime, will also be releasing industrial profits data that could show a bounce in the first 2 months of 2024, following a decline last year. And in the US, the Fed's preferred inflation gauge, the PCE, could edge higher on volatile transportation categories. Well, still to come, MCM Partners shares its outlook on private markets. Here why. It's seeing opportunities in countries including in India as well as Sri Lanka. More on its insights later this hour. Keep it here with us. This is Bloomberg. Welcome back. Here are some top geopolitical stories we're following. Russia has held a national day of mourning for 137 people killed in Friday's attack on a Moscow concert hall. People across the country gathered in memory of the victims amid heightened security at major airports and railway stations. Russian officials are continuing to suggest a Ukrainian role in the massacre, even after the so-called Islamic State claimed responsibility for the attack. U.S. Vice President Kamala Harris has declined to rule out consequences for Israel if it invades the crowded southern Gaza city of Rafah. She told ABC News Washington has been clear in multiple conversations with Israel that a major military operation in the city would be a huge mistake. But Prime Minister Benjamin Netanyahu has rejected U.S. warnings about attacking Rafah, where more than 1 million Palestinians have sought shelter. The U.S. condemns China's latest actions in the disputed South China Sea after two of Beijing's ships on Saturday fired water cannons at a Filipino civilian boat. The Philippines says the vessels, which was on its way to resupply Filipino troops stationed at an outpost in the Second Thomas Shoal, was severely damaged. Some of its crew had also been injured. Washington State Department says Beijing's acts are destabilizing to the region. And now we're also receiving news that the Philippines has summoned China's diplomat in Manila amid those tensions. Well, for more on the geopolitical risks facing investors, let's bring in Mark Franklin, Senior Asia Asset Allocation Portfolio Manager at Manulife Investment Management. Mark, if you take a look at the markets, you don't get a sense that there are risks out there. VIX is so low, you got to wonder whether it's even relevant.
Well, one thing that we're also watching for is bond market volatility, and that's also on the way down as well. So that has a positive feedback loop for equity volatility. So yes, a few months ago when bond market volatility was much more elevated, we might have taken the view that equity volatility was underpriced. But looking to the bond market now actually seems relatively calm there, and therefore there's limited pressure upwards for equity volatility in the very short term.
Do you trade VIX? How do you trade VIX?
Well, it's very, very difficult because typically speaking, there's a lot of erosion as you roll down the curve. And so actually it costs a lot of money to trade VIX, but options on VIX can be a more effective way of playing it.
So lots of geopolitical risk out there. Which one is the most important?
The markets in the world well understands the current conflicts that are underway, whether it's Russia-Ukraine, whether it's in the Middle East, whether it's other categories of tension. We would watch out for things which haven't quite boiled over yet, but could well do so in the coming weeks and months. Look at the border between India and China. India has committed to an increased troop number at the border. There's lots of infrastructure, military infrastructure build up on the border as well. That could lead to a bit of a flashpoint, and also the Korean Peninsula as well. You know, the world is getting more furtive, it's getting more restless, and I think that's the perception that whether it's China, Russia, Iran, they're not comfortable with the status quo. They feel like it disadvantages them, and that's going to lead to attempted pressures and in a coordinated fashion on that status quo in their regional hegemonic areas.
So are there trading opportunities? Should you be buying defense stocks, for instance?
That's a really great question. It's something that we debated internally at Manulife over the last few weeks. The challenge of looking at US defense stocks is actually the defense budget is not growing very fast in the US, 1 to 2% per annum. And at the same time as well, there's a lot of conjecture about whether that military spending should be better used towards ammunition rather than platforms. So actually, the defence stocks may not be the best way to play it. We like the idea of expressing geopolitical views via gold, via crude oil, commodity exposures, which would definitely come into supply constraints should conflicts start to broaden out.
And in terms of particular markets, would a market like Singapore, for instance, which has proven to be stable, do well under such circumstances? In terms of markets, what would you be looking at?
Well, typically speaking, open economies that are dependent on global trade and the free flow of global trade would definitely be under pressure in a situation where global trade was significantly disrupted. We don't necessarily see that as a near-term risk, but certainly speaking, longer term, if we believe that just geopolitical tensions are here to stay and potentially rise further, we prefer economies that are more driven by domestic economic drivers, secular growth stories, rather than being totally dependent on the global economy and economic fortunes.
Some also point out that the risk lies in what's happening in November this year, the election in the US. Does it make a difference who wins?
It doesn't necessarily make a difference for markets, because I think now that there's bilateral view that running very large fiscal deficits is the way forward. You know, fiscal conservatism has been marginalised as a political faction in the US for some time now. Both Trump and Biden are in favour of running large fiscal deficits. Now, how they get there is different. In Trump's mind, it's about cutting taxes. In Biden's mind, it's about increasing spending and redistributing. So ultimately, the outcome is the same. It's supportive for growth. It's supportive for inflation. I think foreign policy, both in terms of style and potential substance, is where we could see differences. I think the Biden administration has been very strong on building alliances and reinvigorating alliances, where I think Trump is much more of a disruptor and questioning historical allies in terms of their commitments to defence spending. So the headline risk will definitely be higher under a Trump presidency, but from a domestic economic perspective, there's not a great deal of difference between their instincts.
How about in terms of the Indian election happening mid-year? It is a gimme that Modi is coming back to power. Is it tradable? How do you position for that, especially for a market that's going gangbusters?
Well, given that the election and the vote counting tends to run for 4 to 5 weeks, you've got this window where there's somewhat of an uncertainty. So yes, Modi is likely to win again, but what is the margin of victory? What is the mandate? If there's any loosening of that mandate, a weakening of that mandate, yes, there might be a bit of a pullback which creates an opportunity. But in general, we don't see any pullback as being significant and lasting for a very long time. There are very, very strong commitments from foreign investors towards the India story because they like the continuity of policy, they like the economic policy programme, the rebuilding of infrastructure, the domestic investment that's going on. And that's a very strong story, particularly in a world where there is a high degree of uncertainty and cyclicality that we've observed.
They like prospects of 8% growth.
Nominal growth now.
Mark Franklin, Manulife Investment Management, we thank you so much for being with us today. Plenty more ahead. Keep it here with us. This is Bloomberg. It's shaping up to be a big week for earnings in China. Major lenders, including Bank of China and ICBC, will report their results after maintaining their benchmark lending rates last week. We'll be looking for commentary from lenders on where China's property crisis is heading. Now, speaking of property, we'll also get results from embattled developers such as Country Garden and China Vanke. Country Garden is expected to see its full-year loss deepen after posting its biggest sales drop in at least 7 years in February. And earnings out of China have been somewhat disappointing so far, with the majority of companies either in line or missing profit estimates. That's with about 20% of stocks in the MSCI China Index reporting. Now, speaking of developers, let's do a check on Chinese developers in play today. Bear in mind that Premier Li Qiang calling for policies to stimulate demand for the property sector in what is seen as an effort to provide more measures to support the property sector, which is about 25% of GDP. Vanke up 4%. Country Garden also higher. Take a look where Long 4 is right now, currently surging by about 8.5%. Kaiser, though, falling after flagging full-year net loss of up to 21 billion yuan. In terms of brokerages, of course, brokerages are falling after CITIC received on-site supervision that's weighing on sentiment. CITIC Securities down about 4.2%. Founder Securities also in negative territory, weighing on sentiment at this point in time. Plenty more ahead. Do keep it here with us. This is Bloomberg. Welcome back here with Bloomberg Markets Asia. China just heading to lunch. The CSI 300 index in positive territory, up 0.4% on a day when Asia's under pressure ahead of the PCE data out of the U.S. Of course, it is about property plays in China. Li Qiang coming out to say he wants to see more policies to support the sector, which is about 25% of GDP. CSI 300 index currently up 0.4%. Shanghai Com also in positive territory. We're tracking the Chinese yuan in particular, 720.09 at this point in time versus the USD, up 0.4%. Bear in mind it slumped on Friday after that weaker than expected unexpected fix. Perhaps it was a case of testing the markets in terms of how far that yuan may go. Take a look at where we are in terms of that currency right now. Quite a reversal from what we saw back on Friday. So China off to lunch, Japan back from break. Let's get to Avril Hong with the very latest. Avril.
Yeah, let's take a look at how the Nikkei is faring at the start of the afternoon session. We, of course, last week saw it running higher. It was after the BOJ. There was a bit of FOMO as well. And then investors really betting on the economic revival in Japan. Today, as you can imagine, there's a bit of profit taking, that pullback from the Nikkei. And we're also seeing this in light of what we're seeing on the Japanese currency. It slides, or it strengthens, I should say, against the greenback after verbal intervention. Let's flip the board and take a look at what we're seeing across assets in Japan, because of course last week we heard the BOJ signaling it's still going to keep things accommodative. We're seeing bonds steadying. The buck almost seems to have been passed to the finance ministry officials, the top currency chief coming in with that jawboning today, because of course it's not just about the levels as the yen hovers earlier near the 152 level. It's also about the magnitude of the moves, and given how the currency weakened last week, it's putting traders on maximum alert. There's a trader's guide that you can read all about on the terminal. Some of the phrases to watch: bold, decisive action. That should really be the attention of the markets as we keep an eye on any intervention, Has.
And suddenly that intervention came when it hit 152 before. Avril Hong, thank you so much for that. Now, staying with Japan, the BOJ's momentous decision last week to overhaul its monetary policy for the first time in 17 years was one that everybody already knew was coming. Let's talk about the BOJ's leaky information problem with Bloomberg opinion columnist Dan Moss. Not necessarily a bad thing, right? I mean, that way it's well telegraphed and, you know, it's controllable.
So the first thing to note, Huss, is all central banks engage in a degree of telegraphing, a signalling of their broad inclinations. It does them no good to have market upsets. But what we've seen in every development since Kazuo Ueda became BOJ governor is just next level. It's known in excruciating detail, and critically, details are coming out during the meeting. Last time Garota Reedy and I wrote about this, one reader messaged me and said, "Oh, the Fed does the same." Well, I can tell you, as the guy once responsible for our Federal Reserve coverage, nothing approaching what the BOJ does happens anywhere else. So people wonder, why doesn't Japan join the Five Eyes? Look, they can't even control their monetary policy information. How are they going to keep national secrets?
So what does it mean? I mean, does it open the path for chaos, more chaos in Japan, with the BOJ adopting such a policy, I guess?
Well, there's a fundamental question here. Who runs the Bank of Japan? The editor-in-chief of Nikkei or Kazuo Ueda? Does the Bank of Japan massage the media, as many central banks do, or does the media massage the Bank of Japan? Japan's made enormous progress in breaking down this sense of cozy club, which has always dominated decision-making there. But look, this must be one of the final frontiers. There's going to be more scrutiny on what the BOJ does now. They're talking about normalization. What we've seen here is anything but normal. They need to get with the program. They want to be taken seriously as a first world central bank. Let's start with behaving like one.
So 13 people were basically at that particular meeting. I mean, it's meant to be kept a secret. You got to wonder whether anything will change for the BOJ in terms of how it relays that message.
Outside scrutiny, if it's brought to bear, will change it. Just go back last month, Sherrod Brown, chairman of the Senate Banking Committee in the US, wrote a very testy letter to Jay Powell after internal probes found 3 policymakers did not violate the law during their celebrated trading of securities during the Fed's very active pandemic period. So ultimately, somewhere, someone in the decision-making process within Japan has to say, this is not first world, this is not up to snuff.
So what are you hoping to see?
I'm hoping to see something that brings the Bank of Japan into the policy mainstream in terms of its media management. That's what I'm looking for.
Don't hold your breath. Bloomberg opinion columnist Den Moss there with his take on what's happening with the BOJ. Now, Pakistan's new finance minister Mohammad Aurangzeb is setting his sights on diversifying the country's funding sources. He told us he's keen to tap Chinese investors by selling as much as $300 million in panda bonds this year for the first time.
Panda bond, the way I'm looking at it, it will have, if you have to be structured, it will have certain credit enhancements. And those credit enhancements then should make it palatable, even the course of next fiscal year, to tap the panda bond market locally in China.
How big or small are those numbers like?
I think the inaugural issue, in the actual size can be as large as $1 billion equivalent in RMB. But my own sense is, even if we are able to tap $200 to $300 million as the first issuance, I think that would be a good start. Because it will allow us diversification, it will allow us something which we haven't tried before, and something which we should have looked, quite frankly, some time back. The second largest and deepest bond market in the world, and not tapping it while we do the dollar and the euro tranches, I think is the right thing to do for the country in any case, irrespective of the size. But my own sense is it will be $250 to $300 million, and then we can keep it at tap.
Okay. And how soon can we tap it? Or how soon would you need to tap?
My own view would be that during the course of this calendar year, we should move in that direction.
Okay, once or multiple times?
No, at least the inaugural issue. Yeah.
You mentioned the rupee, you see it being stable. Do you continue to see it being stable? We have $3.5 billion that need to be paid by June end. You think that will bring some pressure on it? What's your outlook?
My own view is remittances and exports and almost matched by imports. So on the current account side, as you know, has come down, and that deficit number has come down significantly. In fact, February was the number in surplus. And so there's a lot of discussion whether, it's because of the economy slowdown, etc. Maybe some aspect of it is that, for example, in the auto market, the demand for this import of CKD kits has gone down simply because the auto car prices have gone up in a big way, and therefore the demand has lowered. But I think this is going to, the current account deficit is going to help us in our overall balance of payment position. It will support that in terms of reducing the gap. And so I don't really see a huge pressure on the rupee at this point in time. As we move forward, I think it's going to remain range bound around these levels.
For like 6 months or so, short term, medium term.
Well, I think if we continue, you see, the only one I would say the wild card in this whole thing is oil, right? That is the only thing which I think, given the Red Sea and everything else that's going on, can that impact at some point in time? Luckily and fortunately, it hasn't. But that's the only wild card. Otherwise, my own sense is that it'll be, the currency will remain stable.
Pakistani Finance Minister Mohammad Aurangzeb speaking to Bloomberg's Fasim Mangi in Islamabad. Well, still to come, MCM Partners tells us why they're seeing massive investment opportunities in countries like India as well as Sri Lanka. More on their insights next. Keep it here with us. This is Bloomberg. Uncertainty is hovering over the Asia-Pacic's private equity markets, according to Bain & Company. Many investors have put deal-making on hold, worried about slowing economic growth, high interest rates, geopolitical tensions, and volatile stock markets. But our next guest says she's excited about opportunities in the private market space in the region. Janavi Bhagwati is MD of MCM Partners, which focuses on private markets. Good to have you with us.
Nice to be here.
The picture isn't perfect, right? We saw, like when it came to 2023, Japan was the only market which saw growth in private equity activities pretty much. What's different this time around?
Well, I think they're going to be rate cuts. So I think that'll spur things. I think countries like India and Sri Lanka, which is a turnaround story, are going to present opportunities in the private space. So I think we're seeing a difference from 2023. We already see a pickup. Stock markets were at a high at the end of 2023. Inflation was curbed. And as I said, rate cuts are going to kick in, which will also spur investment activity.
Inflation remains really sticky. In fact, those rate cuts have been pushed back again and again. And some say, it may go from 3 to 2. So there are risks to the projections that you're making.
Absolutely. But there are always risks. But I already see a flurry of more activity in 2024 in the private market space than I did in 2023. 2023 was a very, very difficult year, with the exception of Japan, as you mentioned, where they were up, I think, 183% in terms of deal size. The rest of the markets were suffering. But we're seeing a turnaround now in terms of investor interest, in terms of people looking for opportunities. I myself have been asked in Sri Lanka for different investment opportunities. As you know, the IMF has made almost $3 billion of commitments in terms of a loan there. So, but there's some points that they need to adhere to in order for the provisions of that loan. And therefore, Sri Lanka has several huge assets which are being divested, and a lot of institutional players and investors are looking to come in, which will also spur activity there.
You talk about a flurry of activities. Quantify that for us.
So a flurry of activities, basically, I have a lot of investors coming to me and saying, let me be part of the India growth story. How can I be part of the India growth story?
But how big are these deals? What are you looking at?
I have the deal in Sri Lanka is about $250 million. In Bangladesh, we have a deal which is $1 billion potentially. In India, we've got deal sizes which are small, sort of $10, $20 million range, up to $500 million, right? So where you're looking to take a huge chunk of some conglomerate, or it becomes more like a merger and acquisition deal.
You got to wonder what the returns are in a market where different asset classes are giving good returns. You lock in 5% in bonds, and you see many countries are having record highs in terms of their stock markets. Why PE when you can just lock in and have good returns from some of these asset classes?
Well, I think India today has 111 unicorns. So it's the third largest country in terms of the number of unicorns. There you'll see returns that you won't see in the bond markets. You won't see it in the stock markets. And
yet we're seeing the likes of Paytm and Baiju's, which have failed and disappointed.
Absolutely. But Baiju and Paytm were a specific story which were driven by the COVID imperative, which they thought would last forever, right? But that's not the case. When interest rates rose and when COVID kind of stopped, those companies suffered. But other things like food delivery, so we have Swiggy, which is coming out, now has a competitor which is listed called Zomato. So you can always look to it to model Swiggy's trajectory, right? So I think there'll be more nuanced investment now, but there's huge opportunity because of the unprecedented growth we're seeing in countries like India, right? 7.5% projected. Inflation is benign, so there won't be stringent monetary policy. The population is young, hovering at around just under 30. So that'll also drive GDP. We were the 8th largest economy 10 years ago. Now we're the 5th largest economy, and they project we'll be the 3rd largest economy by 2027. So there's huge growth to be taken advantage of in those numbers for investors, both institutional and private.
What assumptions are you making about India's fintech ecosystem? What is there to be excited about?
Well, I think there's a huge amount of innovation in India's fintech ecosystem. We have a huge amount of talent, as I said, because we've got a young population, and therefore they can drive growth. They can also bring prices down, right? So I think that those are two of the key factors that will drive India's fintech growth.
So tech as an asset class remains very attractive.
To investors, yes, very, very attractive. But I would say commodities, energy are also supplanting it to some extent. So tech was the beauty queen, if you were, a few years ago. But now you have energy, commodities also being asked for.
Of course, when you talk about tech, you have to talk about AI. That's darling right now. How do you invest in software and hardware? How best to do it?
Absolutely. So, but we have to make that distinction between software and hardware, right? So NVIDIA is driving the hardware. Software, OpenAI, is it going to be the story, or is there going to be a competitor that comes out? That remains to be seen. But one thing is for sure, AI is changing the trajectory and the landscape of investing, and in terms of how companies run in almost all domains, right? And I see it being a huge part of the future.
The thing is, investing in AI is investing in potential,
yes,
which is yet to be realized. What risks do you see there, and how do you guard yourself against it? How do you hedge against it?
It's difficult to always hedge yourself against risk. I think that's always that's Markowitz says it best. If you have return, you've got risk, right? So I think basically you have to take a punt. So OpenAI, there's a massive amount of interest in OpenAI. It's difficult to source. We've been dealing in blocks of AI for months now, where the trade doesn't quite go through. Sometimes it does, sometimes it doesn't. I think it's just knowing where to go and doing your homework. That's what really is going to prepare you for the investment landscape.
Okay, so if there's return, there's risk, but in this case, there's concentration risk because people are invested in the same asset classes, in the same companies, in the same way.
Absolutely. But, you know, if you look at something like Amazon, it's a large dominant player and there's concentration risk there too, but people have had outsized returns. So if they've got a winning idea and they're doing it right and they're implementing it right, the concentration risk is mitigated by how good that particular company is, but you have to be sure.
Any contrarian view?
Any contrarian view? I think at the moment, real estate and REITs have sort of not been looked at as much as they should have because, you know, COVID came about and everybody was working from home. So they thought, well, the office is defunct. That's not true. The office is still very necessary. And I think that some of those investments are undervalued and should be looked at. And also FMCG, the mainstay, foods, restaurant, all that needs to be looked at. Right now, the hubbub is around AI, but I think don't forget the mainstays.
The thing is, the office is necessary, but we're also seeing a lot of cutbacks in terms of manpower. In tech companies, we're talking about tens of thousands of workers.
Absolutely.
How do you look at that then? How do you assess that?
Basically, I just think that it's undervalued relative to where it should be. I'm not saying that it's absolutely at the scale it was earlier. It's undervalued relative to where it should be because while it may be diminished, it hasn't been eradicated. We still go to the office 2 to 3 times a week. We still have client meetings there. We still need it. So therefore, there's more value than investors are seeing. It may not be what it was.
For Avril and I, it's 5 times a week. Genevieve, thank you so much for that.
Thank you.
Genevieve Bhagwati, MD of MCM Partners. Plenty more ahead. Keep it here with us. This is Bloomberg. Bloomberg opinion columnist Mohammed El-Arian says it's still too early for investors to pivot away from U.S. markets given the country's exceptional economy. El-Arian also told us what he's seeing in terms of Fed's latest rate decision and shared Jerome Powell's comments. Take a listen.
Initially, we had bottom-up drivers, secular themes that were very powerful. But that rally was narrowing. Now, suddenly, you have a very powerful top-down factor that has come in, enabling central banks that clearly are going to do what they want to do, regardless of selective data focus.
Well, let's talk about the Fed if we can.
These two things coming together are really powerful.
Were you surprised by what came out of the news conference with Chairman Powell?
I was surprised by the extent to which he stressed patience in 2 ways. Patience with inflation running higher. He basically dismissed the fact that we've had some pretty surprising, hotter than expected inflation prints. And then the second patience with the balance sheet, saying, you know what, We may get there slower than we would have otherwise, which means that monetary policy is going to be more expansionary than it would have been otherwise. So I was struck that on the balance sheet, he took such a big step forward when he could have waited till the next meeting to do that.
So we keep wondering what shoe is going to drop, right? We keep thinking everyone's bullish and then more bullish and then bullish on top of bull. And you have to wonder, okay, well, when does something break? And we were talking on Wednesday, it's the inflation expectations, that at some point this is going to be a higher, more inflationary environment with a Fed that is less willing to fight it. And yet I'm not seeing it in break-even rates. I'm not seeing it in other places that you normally would. Why do you think that is?
You're seeing it in gold. Look at the reaction of gold, record highs on gold. I think what you're having is, and you've all said it really well, the everything rally. So it's going everywhere. What's interesting now is this notion of market enthusiasm, not economic enthusiasm. There's a big difference. Market enthusiasm could spread to the rest of the world. And that is quite a consequential statement. If that occurs, then the US relative strength is going to be somewhat diminished. I think it's actually too early to pivot. I do think that, to use your phrase, US exceptionalism, economic exceptionalism, isn't going to expand to the rest of the world. The US is really exceptional when it comes to its economy. The others aren't doing what the US is doing in terms of investing in the future drivers of growth. They don't have the entrepreneurial society that we have. They don't have the mobility of factors of production that we have. The US is truly exceptional among other advanced economies.
So do you think it's rational for people to stay in the United States and to keep adding more, even if valuations are at such high levels relative to the rest of the world, to continue to kind of bet on this ship and not expect it to expand elsewhere?
So I've been asked that question every single year for the last 5 years. And every single year, the US premium has increased. And every single year I said, don't fade the US too early. I see some argument for diversifying away from the US, purely on this enthusiasm and on relative valuation, but I don't see it as strong. It is not being supported by fundamentals. People have to realize this. This is more betting on the momentum. And I understand that. The momentum factor is very strong right now.
And that was Bloomberg opinion columnist Mohammed El-Arian. Before we go, let's do a check on markets. China in particular in the money on a day when the rest of Asia is in negative territory. We're keeping a watch on WuXi Biologic as well as sister company AppTec, both surging as U.S. lawmaker leading the Biosecure Act has quit. Analysts have warned that proposed legislation would weaken investor confidence. WuXi Biologic currently up by more than 8%. Also, some of the earnings that we've seen so far, Meituan are currently up by about 8.5%. Profit rose 23%. That is it from Bloomberg Markets Asia. Daybreak Middle East and Africa is next. This is Bloomberg.